All right, we are looking for opportunities within the market. Many investors have been saying that this is a stock picker's market. You can't just buy the broad indices or industries. For more on this and some opportunities, let's bring in Jay Bala. He's the Senior Portfolio Manager at AIP Asset Management. Jay, good to see you. Thanks for coming in.
Oh, no problem.
So it's interesting. We don't talk a lot or enough maybe about some of the small cap companies. There's a greater risk profile with small cap.
Right.
But you do look at them, and you look at them within your hedge funds. So talk to us a bit about your approach.
Sure. We started our hedge fund about 5 years ago. Both me and my partner had come out of the private debt world. And the reason we liked that approach was private debt has the best security package. So it's all senior secured debt, it's liens on assets. And so we did sort of a mix of two things once we created the hedge fund, because I had come from sort of the equity side of the world, and my partner had come from the banking side. And so what we provide is senior secured convertible loans to small cap public companies. And the reason
you provide,
meaning we fund the whole thing.
You do.
Yeah, exactly. So if it's a $5 million deal, we'll fund the entire $5 million. We'll privately negotiate it. We'll privately underwrite it. It's our legal counsel with our own legal paper. Yeah, and then we go ahead and file all the liens and the security and all of that stuff. And then the beauty of the small cap market is that it's so inefficient, right? Like the stock price is hardly ever reflective of the underlying assets. Most people don't pay attention to it. If it's under 100 million market cap, no one really cares. And they don't really have any broad-based coverage on Bay Street. Like nobody covers them, institutions won't buy them. And we always say like the best realized value for these companies is when you actually merge them or sell them. That's when you have a sophisticated party who looks at this and says, wait a minute, there is some value, right?
Right.
Yeah, and so we've had a 5-year track record. We've done quite well over the last 5 years. I remember, when we first came out with the idea, people said, you know what, loans to...
I'm still looking at you like this.
Like, are you nuts?
No,
right?
well, no, I understand, but it is interesting a lot of the time if you're doing private debt funding, that's kind of all you're doing. You're not taking the equity side of it on the other side, and you're not certainly creating a fund, really, if you're also the one funding the debt.
Exactly.
So this is a little bit different.
Yeah, I always say, like, we're probably the most, or like maybe a perfect description of an actively managed fund. Like, we don't just invest, we also help the company grow, we also help the company merge with other companies. And that's where we crystallize a lot of our value. So if you look at our sort of average rate of return over the last 5 years, I think we've averaged above 40% a year, right?
So let's walk through then some of the examples so we can kind of understand what you're talking about on a fundamental basis here.
Sure.
What's one name that we can talk about?
Yeah, so let's start with sort of Desert Lion.
Desert Lion.
Desert Lion was a lithium company, a lithium mining company. And we had entered that transaction in December 2018, so about 6 months ago. And what Desert Lion had was a large lithium deposit. It mined something called the lepidolite, which is a low-grade lithium, and it was trading at next to nothing.
Okay.
Right? So we invested in the company. We invested about $5 million in senior secured convertible debt. We had leaned the mine, so if everything went horribly, we would basically sell the mine and get our money back. Okay. So that was our downside protection. And then we looked around while we were doing the investment and said, okay, look, who do we merge these guys with? I mean, they've got a great mine. It's unfortunately lepidolite, which means, they sort of mined it at $90 a ton and sold it for 70 because the price of lithium had come down. And we said, okay, look, there's a huge market for battery-grade lithium, right? And so what we found was a company in Australia called Lepidico. And Lepidico had a technology that would basically upgrade this lepidolite to battery-grade.
Okay.
So once the merger gets done, they'll be able to produce battery-grade lithium at $5,000 a ton and sell it for like $14,000 or $15,000 a ton. So the valuation completely changes. And this is how inefficient the small cap market is, right? The deal was announced a couple of weeks ago, and it was at a 5.4 ratio of shares. So if you do the math on Lepidico versus DLI shares, DLI should be trading at like 16 cents a share.
Okay. And let's bring it up again then, Desert Lion. But I suppose, with respect to how you're going to make money within your fund, because you are funding them from a debt perspective and you're also buying the stock.
Well, no, it's a conversion rate, so I can convert my debt into equity. Okay,
but I guess my question is, who's going to actually, given the fact that the market's not recognizing this already and the deal's already been announced, how do you make money?
Well, how do we make money?
Yeah,
well,
how does anybody make money if the market's not really recognizing
well, the
this?
great news is all you have to do is buy now and wait. That's the beauty
Okay,
of it,
so
right?
wait. Okay,
Yeah, exactly.
that's what I'm getting at.
Yeah,
okay.
so the beauty is, I mean, like if you looked at, I guess the stock rallied a lot today, but it was trading at 10 cents, right? This is after it's been publicly disclosed, after everybody knows. And all you do is wait a couple of months for the deal to finalize. Then you're going to get Lipitico shares. And that implied rate is going to be 15 to 16 cents. So you're going to make 50% or maybe 30%, depending on what the price is today, for waiting 2 months.
Is there an issue with shares outstanding in the float here at all? No?
Okay. Whatever the shares are, they'll all get converted to Lipitico shares, and then Lipitico trades a lot of volume, so you'll be able to exit your position then.
How do you source your deals? You said that you come from the equity side, and your partner comes from the banking side, so obviously they've got relationships with various companies. Are there certain sectors that they're involved in, or how do you do your analysis and source?
Yeah, well, most of our source deals it's because we've been involved in the industry for so long.
Okay.
So it comes through brokers, it comes through advisors, investment bankers.
Okay.
And I guess we've been around long enough that even companies just talk to us directly.
And it's not sector specific?
It's not sector specific.
Okay.
What we look for is, what we need is an underlying growth segment, right? Like wherever there's underlying growth, that's the sector we focus on. Then we go down the ladder and say, okay, look, the large cap stocks are fully priced in. And we've got no leverage, no alpha generation there. Like, I can predict.
You're not making money on Apple for you.
Exactly. Like, look, I can predict Apple's next quarter.
I was going to say GE, but that's not a good example anymore. That's dating myself by about 15 years or so.
Exactly.
Let's talk about another one, though. I don't know this one, IOTA.
Yeah, so IOTA and PDB Wireless are both in the same sector, and the reason we like them is the actual change in the U.S. So Sprint is going to merge with T-Mobile, which means you'll have 3 carriers in the U.S. that have the vast majority of the spectrum. So the FCC is going to have a very difficult time saying, look, this is a competitive environment. And so what's going to start happening is you're going to have the creation of, say, a 4th
You think?
carrier.
In the States?
And here's the beauty of it all, right? And the reason we like it is because of the IoT, the Internet of Things space. So if you think about something as simple as semi-autonomous cars, like not fully autonomous, just a semi-autonomous. People haven't thought about how much data this car is going to suck down, right? And the projections are huge. It's something close to like a terabit of data per day.
Right.
Right? Compared to what you do on your phone versus anything else, including like if you look at all sort of the Amazon, Alexa talking to your fridge and so on and so forth, there's going to be a massive demand for the spectrum. There's only so much spectrum out there.
So where does IOTA come in?
IOTA and PDB Wireless own the spectrum.
Okay.
So
PDVW is the ticker on the NASDAQ.
Exactly.
So both of these companies kind of playing the same thing, IOTA and PDVW.
Exactly.
Okay.
And so both management teams are blue chip. So IOTA's management team previously sold NTL, which was, 20, 30 billion market cap. PDB Wireless's management team were the founders of Nextel.
Okay.
So they both know the space. And again, we think the spectrum is where you want to be. Like, I don't know if Alexa is going to be the dominant power. I don't know if Tesla is going to be the greatest car in the world. But what I do know is the underlying demand for spectrum is going to be massive.
And with respect to both of these names, you're buying them just individually, small cap, you're not doing any convertible debt with them, or you are buying their debt?
We're invested in IOTA
Okay.
through convertible debt.
Okay.
We do not own PDB Wireless. And PDB Wireless is the bigger one out of the two of them. But we always say if those two companies merged, it would be a much more sizable company. They'd unlock a lot of value. There'd be a lot of synergies in those two.
And just describe perhaps a little bit further in terms of when you see these companies own the spectrum.
Right. In the same way that Bell Canada would own the spectrum.
Okay.
Right?
So they bid and they own.
Exactly.
Okay.
Right? So if you're going to use your cell phone, you pay Bell Canada. The same way, if you're going to use these devices, you're going to have to pay these guys.
Okay. Just last question here, as it relates to investing in small caps, and any kind of words of wisdom, I suppose. I mean, you're very, very stock specific, and I say that in the sense that if you take a look at the Russell 2000 just over the past couple of weeks, people were noticing that the small caps were really suffering, wondering a little bit why, as it relates to the U.S. domestic economy with all the U.S. trade tensions. You'd think that those companies would do better. Right. What do we need to be mindful of as it relates to small cap investing?
Yeah, small caps are not large caps. Look, if you're going to buy an index, you can buy a large cap index because those are efficient. right? Like an Apple is priced to perfection all the time. Unless something dramatic changes, then the price adjusts.
Yeah.
And it's momentary. Small caps, I mean, really, you really have to, you're sort of, I guess the analogy I'd use is you're sort of shopping at the winners, right? Like you're not shopping at some nice store. You have to kind of just dig through stuff and figure out, hey, there's something here, let me buy that, as opposed to, let me just buy an index and hope that things work out, right?
How many names do you typically have in your portfolio?
About 10.
10, okay.
So we're concentrated.
Yeah, and turnover would be very low?
Yeah, I mean, we don't jump in and out. We're not day traders. Yeah, I mean, the whole point is to get in there, be strategic, help management, grow the company, you sell the company, and then invest in the next one.
What tends to be your time frame?
Anywhere from sort of 6 months to about 18 months.
Okay, not too long. You don't have to be too patient.
Yeah, exactly.
That's what I'm getting at. All right, Jay, nice to see you. Thank
Pleasure.
you.
Thank you
That's
so much.
Jay Bala, Senior Portfolio Manager of AIP Asset Management.